Good morning, welcome to the investment meeting of the Teachers Retirement Board for March 6, 2025. I'll start by calling the roll. Brian Berge.
Brian Berge, representing Mayor Hub.
Thomas Brown.
Good morning, Patricia, present.
Good morning. Gregory Crawford. John Dawson.
John Dorsey, designee for control of Radlander, present.
Victoria Lee. Present. Christina McGrath.
Good morning, Patricia, present.
We have a forum.
Thank you, Patricia. Good morning, everybody. First thing on the agenda today, passport funds, January 2025. And I guess Goldman Sachs would take that over.
Thanks, Tom. So I think Gina from our team will pull up the January flash. Just wanted to call out, we did also share to convene the fourth quarter quarterly report. Won't get into it. I know we talked about December results at the last meeting, but I think key takeaway there is that, you know, despite a little bit of volatility right at the tail end of close of the year, overall results for calendar year 24 were very strong, but across the variable funds.
Right, so you can do the January 2025 and the fourth quarter summary, I guess, together?
Yeah, so in terms of January, started the year fairly strong, positive results across equities and fixed income to start the year. No real surprises in January from the major central banks, including the US Fed, which kept rates unchanged, which was widely anticipated. We did see a little bit of a sell-off at the end of January, if you recall the headlines around DeepSeek that caused NVIDIA shares to drop by around 17%. So you do see weaker results a little bit from more of the growth-oriented stocks that did have more tech allocation. We also, on the very last day of January, did see the Trump administration discuss implementing tariffs for Canada, Mexico, China. That ultimately was deferred on 1st February. But overall, for the month of January, if you look down sort of that 1 month column for the variable funds, you're looking at essentially 3 to 4% returns for US and non-US equities. Your balanced fund, which is predominantly passive fixed income, returned about 1.3%. And the variable funds as a whole ended the month at around 21.9 billion in total assets, the majority of which, over 19 billion, is in that diversified equity option. And then there's no questions on January. Gina, do you mind flipping to the February benchmark report? So we of course don't have official results yet for the variable funds, but wanted to share just general benchmark results as proxy for February. And what we saw in February is a little more mixed results. So while non-US equities and fixed income were modestly positive on the month, US equities definitely did give back some of the gains from January. And the dominant factor driving markets in February definitely was a lot of the ongoing discourse around both trade and fiscal policy. So tariffs being one of the key drivers of uncertainty, which we expect to continue. So in terms of our forward-looking expectations, we have modestly reduced our growth outlook for 2025 and kind of widened our tails. So more uncertainty, I would say, on both the upside and downside outcomes there for 2025.
I'm sure Steve will talk more about this too, but since the S&P hit a high February 19th, we've seen a lot of volatility. The S&P's down 6% since then.
When did it hit the high mark?
February 19th.
February 19th.
So a lot of volatility, particularly in the last week and a half.
Good news is Europe's on tear.
Yes.
European stocks are up 20%.
Yeah.
DAX is up in US dollar terms over 20%.
It's been a while since we've seen such a difference in both direction in the markets that looks like this. Usually, over the last few years, we've seen the US run on a hot tear compared to Europe, and now we're seeing time.
How long have they been up for? Since February 19th?
Actually,
Year
year
to
to
date.
date, it's
Year to date.
it's high teens, low twenties returns in Europe, and the expectation is they're gonna reduce their or maybe abandon aspects of their fiscal discipline, spend more money on defense, more money on infrastructure, which will be good for the local economies. Germany's been in a recession with
Might be
really
that
poor
recession.
growth.
Yeah.
So their bond yields, their 10-year bond yields actually backed up, I think, almost 30 basis points in 2 days.
Yep.
A lot of this has to do with the rhetoric that's coming in from the new administration, concerns about tariffs, stepping away from the strategic alliance, the NATO alliance. I know there was a very significant vote at the UN where the US apparently voted alongside of Russia and North Korea. At a point when even China abstained from that vote. So, some of this may be posturing, but the world is disrupted. Mike and I were lamenting earlier, and it's just nothing humorous about it, but it's impacting not just what's going on in the market today and how it's been priced in, it's affecting business confidence, consumer confidence, investor confidence, spending patterns. And now you keep saying 2 words, stagflation, concerns about stagnant growth and high inflation, and talks about a recession. The markets, I think the Fed Fund futures contracts will start pricing in almost 4 cuts this year
Yeah.
because they think that the current administration is going to push the economy into a recession. Not so sure I'm there yet. I know, Amanda, you said you guys have actually ratcheted down your outlook a little bit for growth. Can I ask what's your outlook for your annual growth?
Ooh,
Sorry, I don't mean to put you on the spot.
Yeah.
It's probably closer to 2%.
2%, still
Yeah.
slightly above trend, but lower than it was coming into the
Yeah.
year with, and you mentioned with wider tails.
Yeah.
Sort of the extremes.
Yeah. That'll make sense. I've got a 54-page deck I'm happy to dive into.
I really do. I'm sure. We have plenty of time.
We have 5 deals today, so I got the lecture coming over that I need to be
Plenty of time.
brief.
We can order dinner.
To be clear.
Thank you, Amanda. Any more questions or any questions from Mike or Amanda? Thank you so much. That leads into our professor, Steve.
Thank you for that. Thank you for that, Mr. Chair. I will say just a couple things on the back of our discussion a moment ago. You have a broadly diversified portfolio in public assets and private assets, US and non-US, again, dominated by US holdings, but the portfolio is actually designed to withstand a high degree of volatility in different markets. So, and I'm still very confident in terms of how you're positioned. I think that we'll probably experience some volatility. I don't think you can expect to see the US equity returns that we've seen the last couple of years at plus 25%.
But the man in the West seems to be pushing back.
Yeah.
Push back on no tariffs now for a month for the auto industry.
So there are some concerns about the current administration's policies as it applies to tariffs around being inflationary, deportations being inflationary. But there are also elements that have been discussed about more of a pro-business agenda, a lighter regulatory touch that may support, say, mergers and acquisitions, that would hopefully spur more activity in your private equity book. So right now hopefully we think we see different directions, public equity under some pressure. But if we do get the benefits of a lighter touch, more pro-business administration, that will certainly help both public and private, but particularly private.
Yeah, I think the only distinction there is where we've seen very loud discussion and some more action has been on the tariff policies. We haven't yet seen action. A lot of discussion, but not a lot of action on the other policies that might be more pro-business, which could help fuel or offset some of the, I'll say, recessionary burdens of the other actions.
How does the inconsistency play a role in all this? I mean, a month ago he said yes for tariffs, and then he said no for another month, and now he's saying yes, and now he's saying no. He seems not to have a plan laid out well. And then once it's out there and then he understands the ramifications. And he pulls back, does that all have an impact on consumer confidence? and the
Absolutely.
stock market?
Business confidence, consumer
Mere
confidence.
fact that yesterday, no tomorrow, inconsistency.
I've got some slides that show the spike in uncertainty and how it's impacting people's spending decisions. And again, that doesn't really bode well for economic growth longer term. I'd like to think that there is a game plan here. I'm not so
I'm
sure.
glad, comforting words from you when you said that our portfolio can withstand the ups and downs.
Yeah.
And it was created
Yes,
for exactly this
Exactly.
unpredictable time, so that's comforting.
maybe just go through a couple slides.
Sure, go for it.
Is it Wilfredo or Donald? Could you go ahead one slide, please, Tom? Just a quick look. We talked a little bit about inflation. Inflation fears and actually inflation being above trend or above expectations. The Fed's target is 2%. Inflation still around 3% and perhaps trending higher. Also, inflation expectations are up. So the Fed's on hold. They've been pretty clear about that. Notwithstanding my comments earlier about the potential for rate cuts if there is a recession at some point down the road. On the next slide, just to look at where inflation is. As I said, CPI on the far right-hand side, 3%. That's up from as low as 2.7%. So it's trending in the wrong way. And then the core PCE deflator in yellow, up almost to 2.8%. So inflation's been sticky. The expectation is inflation is going to continue to be sticky here and perhaps rise well above that 3% level. And on the next slide, you can see that this isn't just in the States, that inflation's kind of the ECB, the Fed, and the Bank of England all have a 2% inflation target. And you can see that inflation's been moving here above that. So sticky between 2 and 3%, with potential concerns about it going even higher and causing a change in monetary policy. There was an interest rate cut today by the ECB of 25 basis points. Indications that they're really concerned about in the tariffs and the impact on inflation and growth in the economy there, that they are probably towards the end of their rate cutting cycle because of that. But again, at least some positive downward movement in official rates in Europe. On the next slide, again, that S word came back, stagflation. Again, stagnant growth coupled with high inflation. It's really an unfavorable condition for monetary policy to potentially positively impact the outcomes. We saw this last in the 1970s, certainly a very different environment. We had the oil price shocks of 73 and 78, 79, but again, something to continue to watch. On the next slide, a look at the unemployment level. Unemployment in 2024 in the United States averaged around 4%, where it is right now. That's actually indicative of a pretty strong labor market. You can also see the participant rate on yellow up top, pretty steady at 62.6%. It really hasn't gotten above or at the same level it was pre-pandemic. But again, that may have more to do with demographic changes and a number of people that are hitting 65 or somewhere close to that and retiring. On the next slide, this will look at the impact that the tariffs could potentially have on economic growth. Many of the markets today are concerned that the initiatives may stifle growth domestically and abroad, and again, coupled with inflation. The new administration policies I talked about earlier have a negative impact on, again, consumer sentiment and confidence, business sentiment and confidence in their willingness to spend, as well as investor confidence, which is showing up in an increase in volatility and uncertainty. The next slide's a quick look. This is a familiar slide on the far right-hand side. What I think is interesting here is, again, some of my comments earlier about Europe and the acknowledgement on the part of the Europeans that they need to provide for their own defense, that the U.S. is a less reliable business partner, to take off some of the guardrails they have around deficit spending or fiscal spending. Will probably boost the Eurozone's gross domestic product, which is probably a favorable thing, at least in the short run. Next slide. a quick look at Fed minutes, as I said, reflected earlier that they're on hold for now after 100 basis points hike cuts last year. And again, they've cited in their official statements their concerns about U.S. trade policy and its potential impact on inflation. Next slide. Quick look at 30-year history of some of the largest central banks in the world. As I mentioned in green today, the ECB is now at 2.5%, cutting rates probably for the last time, if not close to the last time in a rate cutting cycle. Next page, credit market spreads continue to be relatively tight. There are concerns that perhaps lenders, meaning investors as well that lend into these facilities, are too optimistic about growth, inflation, and default rates. We'll see how that plays out over time. But again, I would not be surprised to see credit spreads start to widen out and back up if the specter of a recession is being priced in. On the next slide, this is a new slide that really kind of addresses some of the issues that we've talked about in terms of the U.S. Government's deficit spending. You can see up top, if we had a balanced budget, what the spending would look like. And below that, we actually came in with a little over 7% as a percentage of gross domestic product in the U.S., a $2.1 trillion deficit last year. I know that the current administration, through their DOGE initiatives, are focused on reducing expenses for the government. I'm not so sure whether how successful that will ultimately be. But again, $2.1 trillion is a lot to work off. You can see on the chart below, we currently have $36.2 trillion in outstanding debt. 29 trillion of that is held by the public. Couple of interesting facts about that level of debt. The interest expense in 2024, just to service our debt, was $882 billion. That's a lot, particularly when you look at that relative to defense spending, which is one of the largest, if not the largest, defense discretionary item on the budget at $874 billion. So that interest burden and the interest expense associated with servicing that is just incredibly high. On the next slide, just a quick look, familiar slide, credit spreads. This is the extra yield you earn from taking on either investment grade risk or below investment grade risk. Investment grade risk in white, you receive an extra 87 basis points these days. We'd like to see that closer to 110, 120 basis points of extra yield. And in high yield in yellow or orange up top, it's 280 basis points. Whereas if you look historically, it's probably closer to the 300 to 320 basis point level. So things are tight. We expect to see those widen out at some point. Next slide, just a quick look at the yield curve. A little bit of a positive message here. Your fixed income portfolio is now generating more income. The red bar up top is the yield curve as of a couple weeks ago. And if you look at that relative to where it was in, say, 2021 in blue, you're earning another 300 basis points in carry or income associated with those holdings. So it's been a painful process of having rates back up and bond prices move down as yields moved higher. But again, you're at a level where your fixed income portfolio has become a more reliable source of income and ballast for the portfolio. Next slide, just to look at U.S. Treasury 10-year and 2 years relative to one another. In green, U.S. Treasury 10-year yields actually this morning are at 428. They're jumping around a lot. And 2-year yields are at 395. We've actually seen a contraction of the 210 spreads and then a widening out. Again, concerns about if we do have the condition of stagflation, there's a potential for short rates to remain lower for a little bit longer. The Fed may be reluctant to raise rates into weakness, but inflation will affect the longer term rates more dramatically. See, next slide. This is just a look at that 2-10 spreads. It was 18 basis points a week ago. It's 32 basis points this morning and widening. Next slide. Actually, this slide talks about US stocks and bonds. We're really looking at public and private equity markets here. As we talked about earlier, US stocks have come under some pressure recently. US stocks are significantly lower, while European stocks are significantly higher. Again, as I'm looking at the prints this morning, local currency terms, they're in the upper to high teens. If you convert that back to US dollars, they're over 20% returns. And again, that's year to date through the first week of some of the first week of March.
What was our year to date? US?
For US, it's the S&P 500 was probably down by 1%.
Wow, so that's.
Yeah, it's a few hundred basis points, and that's again the benefit of diversification. You're a US dollar based investor. Your liabilities are dollar based, so you're gonna hold more dollar assets. But in this instance, you're benefited through that international diversification and non-dollar holdings. And I would say as a general matter, if you look at your portfolio, your international exposure can be thought of as balanced when we have problems here domestically at home. Infrastructure is probably an outlier in that fully 45% of those holdings are non-US. Again, a lot of infrastructure products, a lot of data center projects are in your portfolio. Private equity, I think it's probably closer to 15 to 20% outside the States. Real estate's almost exclusively domestically. And in your alternative credit book, probably 15% of those holdings are non-US. So again, you have some diversification. Again, you're a US dollar investor with US dollar liabilities and a US dollar bias. But again, some benefits of diversification. I'd say the second point I would make is towards the bottom of the slide. We talked about the return of animal spirits, pro-growth administration, perhaps less of a regulatory touch on mergers and acquisitions, and that should hopefully spur more mergers and acquisitions that would also feed investment initial public offerings and maybe start to see more distributions and activity from your private equity holdings. Private equity the last couple of years has been disappointing in the performance relative to historically. It's done so well. I still think it's a great time to be putting money to work in private equity, given the fact that I think these vintage years, the 23, 24, 25, are going to be very positive for your portfolio in the next 3, 5, 7, and 10 years. So even though it's a little disappointing in terms of the performance recently, I still think it's a great long-term hold. Let's see, in the next slides, we talked about, not to beat a dead horse, the fourth quarter was good for US stocks, bad for non-US, and that's reversed itself. You can see that in the fourth quarter numbers. Just a reminder, and I continue to remind myself, the expected returns on average over the next 10 years. And again, this is not just Rokatan's assessment, it's actually an average of the 5 general consultants. But I think it's pretty representative of where we think things will wind up. Again, you had 2 years back-to-back 25% returns in the Russell 3000, S&P 500, versus an expectation of returns around 6.7%. So again, there is benefit associated with being a diverse, owning a diverse portfolio. Let's see, next slide. Not to beat a dead horse, but we've seen over 20% drawdowns in the global financial crisis and at the start of the interest rate hikes in 2022. I wouldn't be surprised to see a 10% correction. Mike, correct me if I'm wrong, but typically S&P 500 corrects about 10% every 2 years.
Yeah, I don't have the number ahead of, but it's surprisingly, it happens more frequently than you would think. That's the headlines.
No reason to panic. It is more unusual on the right-hand side in fixed income. And again, that's a long-term chart. But a fixed income drawdown of the magnitude that we saw in 2022 was unusual. Again, we're in a better place, a better starting place with a higher base rates now. It's not to say they can't go higher. Next slide. It really just touches on uncertainty. Markets hate uncertainty. Consumers and businesses hate uncertainty, and that's been reflected in prices and an increase in volatility. The next slide, this is actually one of my favorite slides, and no disrespect to Goldman Sachs Broken Town, but I love this slide. You do, okay, we'll get your version
Everyone
next
has a
time out of
version.
respect. This is just a cool way of looking at returns over 20 years in the public market space.
You'll always have to explain this every time I see
Yeah,
it.
yeah, so if I can just point, this is great. So 2024, what this is telling you, this is called a periodic table of returns. So if you look at last year's returns, large cap equity, S&P 500 up 25%. Small cap equity up 11.5%. High yield up 8.19%, emerging markets up 7.5%. These are the returns and how they ranked relative to each other, high to low. Global ex-US fixed income down 4.2. That's not really relevant. You're not in that. Real estate barely breaking even at a little above 1. But what's interesting is you can look for patterns. 2 years of back-to-back 25% plus returns for large cap equity was unusual. And I'd say the takeaway here is you can try to look for patterns, but I really don't see any patterns. What this tells me is you never know which asset class is going to outperform the others. And that's why you have a diversified portfolio. It's also what I find interesting is some of the extreme levels of returns, like when there's a sell-off. Emerging markets tends to be incredibly volatile. Emerging market stocks, looking at an example here.
And Steve, this is just based on the passive return, an index of
That's right.
those very
Not acting
baskets, meaning that my point being, if we select the top quartile managers in private equity or real estate or any asset class, or the best active managers in strategies where we're active, our returns might, you know what I mean, might even be better than this, right? So the point being that like
The only exception is within large cap, US large cap growth, where over the last 10 years, only 9% of active managers outperformed the benchmark.
yeah. So I'm just making the point that, you know, because this is just based on the thing. In private markets, we tend to pick the better manager, not necessarily index.
The other point is you look at this version, so in 2022, which was a really tough year, your top performing assets is cash. Actually, you didn't have an allocation, and we always had some level of holding. The cash came in at 1.46. Everything else was negative. High yield down 11%. US fixed income down 13% again at the end of the year. Developed ex-US equity down 14, large cap equity US down 18, and so on. But I think this is a kind of a fun chart to just.
That would be a nice wall hanging.
It is, and I have it in my own. Yes, there are different versions. There's also private market returns as well, which are a little.
Yeah, this is why you diversify.
Yeah, exactly.
Steve, is that risk adjusted? Like, if you were just glancing at that by color, you'd be like, I should just be only in small cap equity. By and large, it is.
It's not risk adjusted. Those are just returns. It's not the potential for volatility or the short rates. Yeah. Mike said he can arrange it, which I'm sure you can. Short ratios are all over these.
It's probably all over.
Right, yeah.
Yeah.
All right. I'm gonna move it on. It's maybe go ahead, a couple slides, Donald, if you would. Just in terms of the contribution of personal consumption expenditures to GDP, even though we had a rising rate environment from from March of 22 on, you can see that the consumer's been pretty resilient. That may be coming off of COVID with a pent up demand for services and advanced and just spending generally. But last year, December 2024, you can see that the year-over-year expenditures for consumption was 2.8%. So a pretty strong consumer through the end of last year. On the next slide, again, notwithstanding the fact that we had rising rates, the economy's held up really well. When we talk about trend portfolio, and I'll ask Mike or Amanda to correct me, trend is typically what, 2%, 2.1%, the average return of the economy. So we've been above trend for a while, even last year as things kind of tailed off at the end of the year, coming in at just 2.3%. It's still above trend and quite solid. We'll see where the current quarter winds up. See on the next slide, let's skip the next slide, Donald. Maybe talk about some of the tailwinds to inflation. Tailwinds to inflation are not necessarily good. And you can read this on your own when you have time, but just the top, tariffs increase prices, and that's going to push inflation higher. There's a number of other things in terms of tariff fears are pulling some of the orders forward, creating some short-term inflationary expectations as well. But more to come on that. Let's skip ahead a couple slides to slide 31. Just in terms of inflation expectations, so inflation expectations, oftentimes there's a self-fulfilling prophecy. Sorry, on slide 31. Oops, one more ahead. Sorry, two more back. There you go. There you go.
Slides.
No, I think, oh, he's got the old one. All right. Sorry. Okay. It's not the same deck I have. Trade war, so obviously we've had trade wars in the past. And this has created a lot of uncertainty. This is the US Economic Policy Uncertainty Index. And you can see it spiked in 2018 and 19 when the trade wars started and tariffs were being imposed. And again, early on to the new administration, a significant spike. So a lot of uncertainty in the marketplace. Let's skip ahead a couple slides. That one back, please. This is interesting. This is actually really interesting. China actually joined the World Trade Organization in December of 2001. And at the time, in dark blue, you can see all the countries that the US was the principal or the highest trading partner with those countries. The next slide is actually is a snapshot of 2020. So 20 years later, and you can see it's dominated clearly by red, with the exceptions of Mexico and Canada, who are our two primary trading partners still today. What's interesting is that today there are over 120 countries around the world that has China as their largest single trading partner. So things have really changed quite dramatically in 20 years, which is why it's a risky strategy that the current administration is pursuing in terms of potentially igniting a global trade war. Why don't we skip ahead to your performance, Donald?
Hey, Steve, I just got a question about
Sure,
that
Jeff.
slide. At what point does, like, how close to number two is China and Mexico and Canada? Meaning that, like, if you fast forward to 2025 and the current administration and the policies on tariffs, is there a potential that those two, also go and, is it close enough that
That's an excellent question. So there is a slide, one forward, Donald. That slide.
Okay.
I think this might answer, actually, John.
I think you were gonna skip it. That's why I wanted to-
Yeah. Canada
Yeah.
and Mexico make up 43% of the US imports and 40% of our exports. And you can see how it's stacked at the bottom, Canada in green, China in dark blue, and Mexico in light blue. So picking a trade war with Canada, China, and Mexico is not without significant risk. These are our largest trading partners.
In the country, I see blue in the middle. If you go back to that.
One back.
Go one back?
Yeah, go back. Yeah, see that?
Above India?
Country right to the northwest of India. It's like country is that blue. What's that gas?
I don't know.
Nobody taught you how
Do we have a lot with China?
Okay, I could.
I don't know. I can tell you that.
Just a real match.
Is it Ukraine?
Who went to a liberal arts school? Oh, there we.
I'm mobile here, so let's go.
Brian, the question is, who is this? Is there one of our
I
members?
believe it's Afghanistan.
Afghanistan.
Is that, oh, yeah, that checks out as like a residual aid measure, yeah, that checks out.
Thank you, Donald, voice from beyond.
Yes.
Yeah.
Thank you, Donald.
Matt, I really appreciate you sparing me the wrong
Yes.
answer.
Thank you.
What?
I did very poorly on Jeopardy, ask the wolf question.
Are we jump ahead to performance,
I
Donald?
don't do very well with that
Can
category.
you strike it in reference to other countries we named that weren't Afghanistan?
One more, please.
So it looks smart.
There we go. This is actually teachers' net plan returns through December 31st of the fourth quarter of last year. You can see that the quarterly update on the far left, the 3 months is negative. Obviously we've had some challenges in that, and that includes private markets as well. This had more to do with the sell-off at the end of the year, the sell-off in non-US stocks and the backup in yields. I believe at one point US Treasury 10-year yields were as high as 480, which meant yields are up, prices are down. But more importantly, you focus out long-term, you've hit your 7% actually assumed rate of return or your return target of 7%. The next slide just is a fancy way of showing that. I think this is a great chart to look at consistently, but that blue line is what your portfolio would be valued out of the 7% annual return compounded. And you can see you're at right at that level. On the next slide, look at your net public market returns to the fourth quarter. And on the left, you can also see the assets under management. So you've got a significant holding in US equity at a little over $28 billion, which generated, again, given the strength, particularly in December, a 2.9% return. And if you look all the way out the curve, it's actually delivered net public market returns of 12.6%. Again, strong equity performance following the global financial crisis and then some. US, non-US equities didn't fare as well as we talked about earlier. And again, fixed income with the backup in yields in the fourth quarter was a little bit challenged. One slide ahead, please, Donald. Just to look at your excess returns and basis points. This is the alpha that's been generated through active management. We continue to see some struggle in the developed market ex-US. Although, again, we have to remind ourselves, if you look at long term, again, five years isn't really long, 10 years, it still delivered positive alpha over time. The one outlier there is your custom fixed income, which is benchmarked to a slightly higher duration exposure, which has been a little bit of a drag. On the next slide, this is just a different way, a more fancy way of looking at your returns over those periods of time, 3 years, 5 years, and 10 years. Your portfolio is actually the darker portfolio up top. See dark blue, dark orange, and dark green. That's actually your portfolio return relative to your benchmarks. And if you look kind of down across the bottom, you can see US equities underperformed a little bit more recently in 3 years, pretty much met the benchmark in 5 and 10 years. World ex-US underperformed in 3 years, but outperformed in both 5 and 10 years. And on down, you can see actually high yield has been a strong performer, outperforming your benchmark consistently, as has cash. On the next slide. This is an enhanced slide. So now we've annualized this. On the right-hand side, those are the average fees you pay for public market management. And your total fees that we pay is $104 million on an annual basis or per year. This is a great slide. It's a snapshot. And I'm working with Dan Haas, who's our interim chief risk officer and head of reporting, to develop better analytics. We need to be able to show you over time and demonstrate what are we doing to reduce the fees. So we'll have a little bit of that, I think, in executive session in terms of a manager update, where we were able to successfully renegotiate fees as well. But we're proactively doing that with a lot of vigor right now.
I'll just add a verbal overlay. I want to say 10 or 15 years ago, that 12 basis points was probably closer to 15, 16.
Yeah. The average, right?
The
on the bottom,
average,
most
yeah.
strategies, yeah.
Yep.
But we need to provide them. We can and we will do a much better job in terms of providing more insight into public markets and private. What are we doing to move down the fees, both in action and then what are the results? What does that trend look like? Let's see. Net private market returns on the next slide. Again, real estate suffered a little bit with higher interest rates, delivering a negative 2.9% return last year, or year over year, it's through December. Actually, that's through September, yeah, sorry. More important, if you look at your private assets, your net performance has all been positive, and then quite some. Like to focus, I think, on infrastructure, which is a more recent private asset to be developed. You've been in it for a while with great outcome, but it's still a developing portion of the market. But steady Eddie, 1 year 13.8%, 3 years 11.7%, 5 years 12%, 10 years 12.1% since inception, 12% returns. That's significantly above your benchmark. I would love to take credit for this, but this is really has to do with Petra Nikolova, who I think is exceptional. I think she's probably one of the very best infrastructure investors in the marketplace. She's very thoughtful. And as we scale up that business, we hope we can continue to maintain this really quite strong outperformance. Why don't we skip ahead a couple slides and maybe just look at your different returns for private markets in that summary page. So again, here it is. Your portfolio is in dark blue, dark orange, and dark green. And you can see, just to my point about infrastructure, it's significantly outperformed your benchmark historically over 3, 5, and 10 years, as has alternative credit. Again, great outcome. Private equity has been a really strong performer. It's been great for your portfolio, generating returns on average over the last 10 years of close to 13%. It's been the highest single performing asset. The problem is relative to its benchmark, it has a 300 basis point illiquidity premium in addition to the Russell 3000. And to be honest, Russell 3000 the last couple of years has been on a tear. It's been over 25% return. So it's kind of hard for any asset class to keep up. But we continue to maintain a high level of confidence in our private equity capabilities and holdings.
These are the time-weighted return.
Exactly,
Yeah.
yes, yeah. And with that, I'll open up any questions.
Thank you, Steve. Any questions for Steve?
Mr. Chair, we were also going to go through a risk review, which we're going to suspend today only because there's no material changes in risk right now. I think they'll be developing over the course of time. But we also because we have got 5 deals to go through, we thought we'd just hold that off until the next quarter.
Any questions for Steve? Great, let the record show that Anthony Giordano is present. And I think that concludes our business in the public agenda. Thank you, Steve. Well done. Is there a motion to go into executive session? So moved. Is there a second?
Second.
Thank you. It's been seconded. All those, any discussion first? All those in favor of going into executive session, please say aye. Aye. Those opposed say nay. Abstentions? We're now in executive session. We are now back into public session. Welcome back to public session. At this time, we will have a readout from our own Priscilla.
Thank you, Mr. Chair. I think I get a second shine. Okay. In the executive session of the Passport Fund, there were 2 manager updates. In the executive session of the Pension Fund, there was an update on preliminary performance. There are no manager updates. There were 2 alternative credit presentations. Consensus was reached on both. There was an infrastructure presentation. Consensus was reached. And in the tail end of the meeting, there were 2 real estate presentations. Consensus was reached on both. Details to be made available at the appropriate time.
What a great way to end this meeting. Perfect.
Well done.
Thank you.
So I'll make a motion then to adjourn.
Well, before we make the motion to adjourn, are there any questions, comments, concerns?
Would you like to thank anybody before we end?
Absolutely.
I will hold back my
Thank you. I would like to thank publicly Adrian Lissaru, our TRS tech, and our recorder, Will Montague. As always, appreciate it. Now at this time, if there's anyone who would like to make a motion to adjourn the meeting, you may do so.
So moved.
It has been moved by John. Thank you, John. And it's been seconded by Victoria. Are there any questions?